To TradeSpoon. My name is Vlad Karpel. I'm CEO and founder of TradeSpoon. And today we're going to have our weekly strategy roundtable where we talk about current market conditions and any questions you might have about your subscription. For those of you who are new, welcome. If this is your first live event, do me a favor, tap in first. Always want to welcome new subscribers. For all of you returning subscribers, welcome back. Don, Joseph, Kevin, Martin, Peter, Rajesh. Glad you guys were able to make it. My background is technology. I have a master's degree in computer science, specializing in statistics, artificial intelligence. We have a team of financial engineers that are building great models using latest advances in neural network technology and predictive analytics. So I'm very blessed to be part of it. And I've been managing my own money. I've been part of several startups here in Chicago. And once they went public, I decided to manage my own money. I've been doing that for over 20 years. Disclosures are very important. Please read them. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risks and be willing to accept them in order to invest in current market conditions. If you're new to trading stock or options, I encourage you to visit optionstrading.com so you understand the risk associated with trading stock or options. I'm not a financial engineer. I'm not sorry, I'm not a financial advisor. I'm not registered with FINRA or SEC. I'm here to show you what I do in my own account based on my own risk tolerance level for general education information purposes only. All right, let's take a look. 2024, we're almost there. One more week left. Let's sum it up. QQQ trying to break through the all-time high, basically at the 2021 highs. 406, 407, spiders, a little bit, basically retesting, maybe 1% away from all-time high, around 481, 480. Small caps are trying to break through major overhead resistance, right, back to April of 2022 high, also making marginal new highs in the past almost 2 years, year and a half. What else? And interest rates have dropped significantly, right? 10-year yield went from 5 to 3.8, over 100 basis points drop on 10-year yield, on 2-year yield from 5.25 to 4.25, right? So also 100 basis points drop. And drop from $1, right? We were as high as 114 and we're back to almost 100. So 14% drop in dollars since October highs of last year. So the question is on everybody's mind is, will we have a recession or will we not, right? Inflation looks like trending lower. We have PCE data today, CPI, PPI data from Europe, from China. Looks like supply chain issues are behind us and the commodity prices are significantly lower. Even shelter prices continue to trend lower. Unemployment is staying low level, right? Everybody's employed. And potentially earnings reaccelerating in the next year, earnings growth accelerating, and the concept of soft landing, right? Everybody's talking about, is this similar to 95 where Fed raised interest rates rapidly, then they lowered them rapidly, then from 95 to 2000, 5 years of higher highs and higher lows during because of the low interest rate environment, right? So if we don't have a recession, the next 6 months, let's talk about maybe to summer, right? To May, June. Up and away, maybe 10%, maybe 15%, right? So that would take us to maybe 520, maybe even 540, right? Let's call it 520. We'll be conservative, 10% up, right? So that's scenario number one. Earnings season starting, next earnings season starts in January. We see growth reaccelerating, no signs of recession, and market is up 10 to 15% in the next 6 months. The second scenario, there are signs of recession, right? We have FedEx, dropped, Nike dropped, earnings spike in credit card defaults and credit card balances, spike in the potential spike in unemployment rate. And instead of earnings growth reaccelerating, it's trending lower. And Q1 is worse than Q4, Q4 worse than Q3, and Q1 is worse than Q4, and we're dropping 10%, right? So it will take us at least to 4, maybe revisiting October lows in the next 6 months. So that would be scenario number 2, right? 10% up, 10% down. Okay, so this is the concept of hard landing. That it's not going to be like 95, it will be similar to 2003 and 2008, right, when the interest rates were raised. And this is similar to 95, right? And this is similar to 2000. Maybe not, I'm not talking about magnitude because there's serious issues were in 2000, right? We had internet bubble and September 11. 2008 we had financial crisis. So I'm not talking about the magnitude of these, but the point of some kind of recession, right? 2000, 2008 we had severe recession. We don't have to have severe recession, or we 95, right? Where immaculate disinflation and unemployment didn't go up, and companies started making a lot more money. So those are the 2 possible scenarios. I don't think we're going to spend too much time kind of going nowhere, right? Since November 15, we moved maybe what, 20, maybe 4 or 5%, right? So we're not going to move in 2 months 4 or 5%. Volatility will pick up, right? Because we either green light and no signs of recession, or red light and expectations are a little bit ahead of everyone. So scenario 1, scenario 2, very important exercise. Why is this exercise important? Why do I do this? Because I think that's very crucial for any type of trader, or even if you're an investor, right? If you're a trader, you have to have a well-defined target gain and stop loss and how much money you're risking. If you're just an investor, you still need to kind of look at the macro and microeconomic conditions just to determine how favorable it is for the growth. And if you don't have a tight stop, how much cash do you want to have? Because you're not trying to time the market, but if there are 10% pullback, you want to have cash to utilize it. If there's no 10% pullback, you're all in equities and bonds, right? 60-40 is back on. Next year should be the year of bonds. Everybody kind of talks about, anticipates, but if there's 10% correction, maybe you shouldn't be 60-40, maybe it should be, 40-20 and 40 in cash, or 30% in cash, right? So very important exercise, whether you're a long-term investor or short-term trader. If you're obviously day trading, you want to do the same exercise for the next hour, for the next day, right? If you're medium-term, you want to look at the weekly, next couple of weeks. But you want to go through these positive and negative reversals. So why are they important? To determine position size, right? Because otherwise, if you don't do this exercise and you don't know what your stop levels are or potential drawback, then how do you know how much money to invest, right? Biggest mistake, I think, people just always buy 100 shares, always buy 1,000 shares, or they always invest $1,000 or $5,000. I think in both cases, I think that's problematic, and you should look at this. What is the maximum risk you're willing to take per position? Right? That should be the approach. And these exercises can help you determine, right? Not only, just mental exercise, try to make it very vivid and emotional, right? How would you feel if you're bullish and you set 520 and the market drops to 420? How would you feel, right? Are you prepared for that? Or if you think market is going to drop to 420, how would you feel if the market is at 520, right? That will help you determine the right position size, right? That's a very important concept. So let's go over that. How many of you say 1? We're going up 10-15% in the next 6 months, soft landing. Or scenario 2, we have mild recession and market is a little bit ahead of itself. Fed is not going to lower interest rates in March, and market, once it realizes it, drops 10%. 2. All right. Wow. Yesterday a lot of 1s. Everybody's 2. You guys must be going to a live trading room, or you heard my speeches. Okay, anybody won? Martin, weren't you won before? Martin, Peter? No? Okay, Not a single person won. Come on, I know somebody says one. Martin, usually one. Okay, fine. So majority of you said two. This is not the most popular opinion. I'm also gonna go two. Just remember, we are kind of swimming against the current, right? Majority of the people think it's one, whether it's JP Morgan or Goldman Sachs or RBC or a bunch of other wealth management. Maybe Morgan Stanley would be kind of, again, the outlier in this. So we think like Morgan Stanley. The bottom line, nobody knows, right? Nobody knows, right? Obviously, if you were bullish when we did this exercise in 2022, you made a lot of money. If you were bearish, you had to sustain some losses, right? We're kind of starting this year in the opposite, right? Here we were extremely oversold, extremely bearish sentiment, right? Any positive news on the market rally. We're starting this year in the opposite end of the spectrum, right? All-time bullishness, everybody's bullish, everybody's optimistic. Any negative news, and you have a surprise to the downside. And for that reason, I'm also in category 2, because the yield is extremely oversold, the dollar is extremely oversold, and too much euphoria, right? With the expectation that Fed will lower interest rates. Well, Fed says 3 times, but the future implies 6 rate cuts next year, and first one in March. So as soon as people realize we might not have a rate cut in March due to CPI, PPI data or unemployment data, or Fed is going to make it clear that they're not going to lower interest rates 6 times next year, and it's only 3 times, and it's towards the end of the year as opposed to the beginning of the year, that will create a negative surprise. And I'm not talking about geopolitical risk and Taiwan and Middle East and stuff like that, but because I can't predict. But surprise on the overly bullish sentiment, I think, can happen. So for that reason, I'm going to manage as if 2. Whether you're bull or bear, I don't think it really matters, right? You can basically say, Vlad, as long as we're above 460, you can be a bull or you can be a bear. You don't want to be aggressively bearish, right? As long as we're below 480, you don't want to be aggressively bullish. So you need a breakdown of this level, right? Either January starts, right? The first 2 weeks we might have, they're usually bullish, right? Because all that euphoria, everybody had a good time during Christmas and during New Year. Usually from seasonality point of view, people are happy and they're very optimistic. Then towards the end of the January, once the earnings season starts, or if CPI and PPI or macroeconomic data comes in worse than expected, right? We had earnings from Nike today down 10%. We had earnings from FedEx down 10%. These are large 3 standard deviation moves. This is not just a little negative surprise. These are major global companies that are revising their future revenue down, right? Not all of them, right? We have good earnings from Broadcom. So, but these are good proxy for global economies. So end of January, probably, some volatility picks up, right? And then maybe towards the end of January, February, we break through the 460, right? So then I would be more bearish, right? As soon as we break 460, that's my sign. Okay, something is wrong, I'm out. I would be careful in January, the first 2 weeks, to assume that even if we have 2 weeks of breakout above 480, that this is a positive breakout, right? I would wait, and if end of January, beginning of February, we're above 480, I would say bears are probably wrong, and we're going higher, right? So we do need, I would say, at least maybe 3-4 weeks above 480 to kind of say that green light, right? So you have to be alert, right? You have to be nimble, right? And be able to make your decision as data arrives, right? If data arrives for the next 6 weeks where no signs of recession, earnings is strong, then there's no reason to fight the trend. If we see the opposite and we're below 460 for a couple of weeks, then it's a problem. Okay. So that's my view on the market. Any questions? Oh, Martin, what is my question? Are you bullish? Are you doing 1? If you think we're going to go up 10% in the next 6 months, or 2, type in 2 if you think we're going to be down up to 10-15% next 6 months. Going into October. All right, Kevin is 3. Okay, Kevin is always waiting for Black Swan event, and a lot of people do, right? A lot of people think that what happened last March was the, regional banks. This is not an anomaly. This is not the end of it. This is just the beginning, right? And as that gets rolled over and has to be refinanced, you're going to have more and more issues similar to what we had in March. I mean, them very difficult. Can it be March? Can it be October? I mean, okay, that would be difficult to. I mean, we all try to time it in 23 unsuccessful, right? And market just keep going higher. Okay. Very neutral. All right, Martin, thank you. Joseph, TLT, I think, well, I was wrong on TLT, right? I was very bullish on 23 on TLT, a little bit too bullish on TLT, right, in December. Well, actually, it's kind of flat, right? So if you follow my advice in December, I was bullish on TLT, you're basically flat for the year and have to take a lot of volatility on the upside or downside. It's the same answer that I gave in December of 22, same answer as December 23. The reason I was wrong, right, and a lot of people were wrong, most people were wrong, because the inflation, was higher than anticipated, higher for longer. Everybody anticipated that the Fed will cut interest rates, at least twice this year. So majority of the people were wrong, right? Even if you were bullish, you were wrong. You were right for other reasons like generative AI and NVIDIA earnings. So coincidentally, you are right. But the main premise of being bullish last year, most people are wrong, right? Most people said oil is going to go to 100, earnings will reaccelerate, no recession, they were right, and interest rates will drop significantly, right? Fed will lower interest rate. So a lot of these assumptions didn't work out this year. It's the same assumption, right? As long as the inflation doesn't come back up and Fed is going to start lowering interest rates, whether in March or June or September, it doesn't matter, right? But as long as they don't change their ratchet to higher for longer, TLT should break above 100, should break above 110 next year, right? Whether we have a mild recession or soft landing, in both scenarios, it should be the year of treasuries. The only risk is inflation comes back, right? Fed lowers interest rate, it's already factored in, and all of a sudden, unemployment's still low, earnings reaccelerate, people's, the euphoria of spending money after COVID continues, and recession and inflation comes back up. And then Fed says, no, let's, higher for longer again. Well, then TLT is going to drop back to 82, right? It's an unlikely event based on the current data that's coming from Europe and the United States and China. You don't see any comeback of inflation. As a matter of fact, it's decelerating at the speed faster than the majority of people anticipating. Case in point, today's PCE data, CPI data this week from France and Germany. So, it's a risk, but it's a low probability event. It's a risk, but low probability event. So TLT should, a lot of people calling for the year of both bonds and equities. TLT is going to keep going up. Stock market is going to go up. Like everything's going to go up next year. So we'll see. So I do think treasuries will go up, but equity not one way. I mean, by the end of the year, I think we will have a strong rebound. I think bull market is coming, but it's just, a little bit too early, I think. Using a lot of US treasuries. Very good, Martin. Not. History might repeat itself. Kevin, no, I was not here since 1968. Since 1988. But no, I wasn't in Chicago since 1968. Okay, since the 90s. Okay. Good. So then how do you trade, right? What do you do? So at TradeSpoon, we have different, kind of started explaining this, 2 different types of traders. And subscription for, just keep in mind that we all have different background, right? Some people traded like Kevin since 1968. Some people, traded since 2 months ago. So we have all kinds of subscribers. So if you're an experienced trader, right, you've been trading long enough, you know how to look at that future rehearsal exercise, right? You know how to look at the target gain stop losses. You understand what a prospect theory is, right? And that our relationship with our gains and losses, at least you recognize it. You might still make mistakes, but at least you recognize that, losing $250 is a lot more painful than making $250. And at least you realize that, somebody $250 could be okay, and for somebody it could be a disastrous result, right? So as long as you understand what a loss aversion is and prospect theory, then you've been trading long enough, you have a trading plan, you've been pretty disciplined. You're looking for models, right? You're looking for models, you're looking for trade ideas. So we have, I would say, Stock Forecast Toolbox, very powerful tool. People that experienced traders love it because it gives you guidance, right? It basically says spiders at 477 is oversold. At 470, consider buying it, and the trend is turning negative, right? And you can enter any stock, any ETF, look at 10 days, look at 6 months, right? 6 month spiders, 470, market is overbought, right? I mean, can it go higher for 75? Can it go higher for 80? Sure, but it is overbought, right? And there is a chance that in the next couple of months, it might drop to 416, right? So in terms of giving you idea of what is overbought, oversold, and trend, right? If you see the trend has turned neutral, we were very bullish, in October and September, but now we're turning neutral. That is very important information, very valuable information for any, experienced trader. If you're not experienced and, you're asking question, well, it says 470, but it's 475, what is wrong with this model? Then you probably didn't trade long enough, right? Or you're not experienced enough. And then I would propose to you be part of our live trading room, right? In live trading room, we can talk and we can discuss and I can explain what you can and cannot use, what you can and cannot rely on, right? And I can give you trades, right? Like today, I traded Nike, right? I did iron condor, right? I sold calls, right? I sold 136 call spread for 36, closed it for a penny, right? So I made 36 cents, right? I'm looking at, I didn't do the put. If you were in the live trading room last night, I did say, I think the risk is to the downside of Nike because of China and how weak the China demand is. I was kind of right? Especially on the future revenue growth, they revised down to single digits. And market didn't like it. So if you did buy a put, long put, then this would, was an additional. So that's example of either synthetic stock, right, where you short call, buy put, or I do iron condor. Like on Micron, I actually did iron condor. Sometimes I trade stock. Even today, I wanted to show an example. I bought at 141.27, closed at 141.90. Half of the position, half at 141.33. Here I captured 60 cents, try to capture 0.5%, 60, 70 cents, right? If I can capture 0.5% using underlying stock, right? Whether it's an option or stock trade, I believe in incremental gains, right? The word escapes my mind, but the idea of incremental gains, right? And they accumulate, right? They accumulate over time. So I'm doing both stock and option trade. Some of them are longer trade, like silver. I'm trying to close silver call spread in January, right? We're getting close to exit. Verizon, trying to close Verizon call spread. Bank of America. So you can see that I'm doing both stock and option trades, sometimes short-term trades, sometimes medium-term. Some people complain, they say, listen, why are you doing these short-term trade? I'm a long-term trader. Why are you doing long-term trade? I'm a short-term trader. The answer is, you need to be then in part of live trading room, and then I can explain whether it's a short and medium term, and based on your likes or dislikes, then you can decide which trades you should or should not take. The good news is that if you're part of Elite Circle, there's a morning bell and closing bell, so you have live event with the market commentary, and you can actually see me trading these examples in the morning bell and in closing bell, so first hour and last hour of the session. If you're busy, you don't have time, look at you can view the recordings. So I think Elite Circle is very important, even if you're an experienced trader, but you just want to be able to enter phone and get these messages, but then you will decide which trade to take or which not to take. I propose to start with Elite Circle. You can enter your phone number under SMS alerts, you can view the recordings, and I've been always saying that, you know, just getting SMS messages is enough. You might be successful, you might not, I don't know. But if you're committing to learning, right, and for the next 3 months, you either participate in morning bell or closing bell, or you watch the recording, right, this is 1 hour. If you spend in 1 hour a day, or if you look at the recordings and fast forward maybe 30 minutes, maybe 40 minutes a day, and you follow the instructions during live trading room, you follow the trading plan, you follow a written down journal, and you do this for the next 3 months, come back to me. You know, I think your performance is going to increase multiples of our monthly subscription, right? Multiple, right? Significantly. So from my perspective, it's there is no risk, right? You can sign up, follow the instructions, and you know, the only time people cancel if they don't follow the instruction, right? They ignore live trading room, they don't watch the recordings, they get a SMS message, and you know, they enter half an hour later or 2 days earlier, or not at the right price, or they just put in too many buying too many shares. That I have no control over it. But if you believe in education and you believe in training, and you can spend an hour a day or 40 minutes a day for the next 3 months, you will be successful, right? And if you're not, send me an email. I'd like to figure out why. So that's Elite Circle, and I would start with that, right? If you're an experienced trader, you know, and you want more ideas, we have these 3 services, right? Active Trader, Weekly Trader. This is where Google came in, right? Basically outlines you the plan, right? It's not like something I just decided in the middle of the night. This was posted last night with entry and exit points, right? It gives you different strategies based on pre-market. Last night, I didn't know how the market is going to open or close, what would be, you know, PCE data, right? So, but you know, it gives you strategy, right? And here I'm looking for 1%. You know, either enter at 139 if the market future is down. If they're not, you enter at 140.42. Or if it gaps up, the way I do it, I would just wait 15 minutes, and then you know, I enter after 15 minutes based on stop loss, right? So, and you can do both stock or option trades, right? But most of these stocks, I try to find them liquid, based, you know, make sure that there are weekly options, make sure that, you know, bid and ask spread is tight. Not always, but that's the goal. And I'm looking for 1%. So that's where Google came from. You can do Weekly Trader. I mean, same idea. It's a different model, but you know, holding time longer, right? Instead of looking 1%, you look for 2% on Weekly Trader, and you hold it longer. Monthly Trader, you look for 5% gain, but you know, you hold it, you know, potentially for a few months. So those are the different models and different picks that you can use based on your trading style. You know, Active Trader is day trading, short-term trading. Weekly Trader is, you know, momentum trading, swing trading, and then monthly trader, kind of longer term trader, medium to longer term holding time. So those are the picks. So I went over stock forecast toolbox. We do have seasonal chart. It's been working pretty well. You know, usually you don't just make a decision based on seasonality, but you know, it tells you that 4 out of 4 lower, that the market is overbought. 81% correlation, basically since August, market has been extremely well correlated with seasonality, right? It dropped from August to November, October. It rallied from end of October to December. You know, from seasonality point of view, usually January, February is volatile, right? January, February volatile, and then usually in March, market rallies, right? It doesn't have to happen this way, right? I said the same thing in June and I was wrong, right? Because there was NVIDIA earnings. So instead of market going lower, it went higher. So seasonality doesn't always work, but if there are no events or like generative AI all of a sudden being invented and everybody thinks this is the next, invention of air conditioning or electricity, right? Everybody thinks that AI is going to be like, Thomas Edison electricity. I mean, could be, right? Then it's worth investing, and then you will have divergence from seasonality and current prices. So those are the tools. If you're, sometimes some people say, well, there's just too many trades. I'm only an option trader. Okay, you can follow our premium portfolio. This is only option spreads, options, or spread trader. If you don't need the tools, you just want to follow my trades, then shadow trader. If you just want stock trading, then it's robo investor. So there are different services, but they divide it into either you're following my trades via SMS and emails, or you don't. You have your own system. You just need tools. Forecast Toolbox, Active Trader, Weekly Trader, Monthly Trader. Any questions on the tools, services that we offer on TradeSpoon? Right, you can always select here the platform and pick different education, forex, futures, anything that kind of gives you explanation. Any questions? Don, thank you. Merry Christmas and safe and happy holidays. Really appreciate your time. Thank you, Don. Don, Joseph, JP, Kevin, Martin, Peter, Rajesh, Tim, Michael, John, Steve, Mark. Any questions? All right, so instead of opportunities, again, I kind of went over right now. I think market is overbought. The best rally is behind us. I would look at the stocks that kind of clear some kind of overhead resistance, right? I mean, I like Boeing, but it's overbought, so I would wait. But what do we talk about? Dropbox, right? So high beta stocks like Dropbox, if it cleared this overhead resistance, continue to rally. I mean, as long as spiders don't drop below, 460 level, Dropbox is going to continue going higher, right? Potentially getting to 32. Bank of America, right? Bank of America cleared this overhead resistance for a couple of weeks. As long as we don't have a pullback or signs of a recession, it can continue doing the catch-up trade, right? So Bank of America. Semiconductors, right? Semiconductors, perfect example. It cleared the overhead resistance, all-time high. Path of least resistance until it drops below 160's higher highs. Home builders, right? Lennar, Pulte Group. I mean, they look like semiconductors. So once you cleared certain overhead resistance and you have this momentum based on the weekly charts, right? Medium-term charts and long-term charts, right? Then, those are the stocks I would invest, right? If you see that stock is struggling, like we talked about Roku, right? We said Roku cleared 195 level. So as long as it stays above 95, you can invest. But now it's dropping for whatever reason, right? I mean, maybe because it's almost doubled in price, but it's losing momentum. So then I would, have clearly defined stop level and just get out of Roku, and maybe Shopify is the place to go, right? Maybe Shopify, right? Because it cleared. Same thing, it cleared and stays above this line, continues to go higher. So Shopify probably is okay to invest, and with clearly defined stop level. Amazon, same thing, right? It cleared 140 overhead resistance. It's at multi-year high, and there's really no obstruction to go higher, until there are signs of recession, and who knows when we're going to have signs of recession. So that would be the setup for this medium-term to long-term trading. Silver, gold, I think this is going to be the year of gold and silver, right? Not one-way trade, right? We're kind of knocking on the door of all-time high, right? And dollar continues to trade lower. So with all the money being printed, most likely gold will break out and silver will break out of this range. But the question is when, right? It tried it in 2012, right? Or 2011. It failed in 2011. It failed in 2020. Failed in 2022. Failed in 2023. Failed in 2024. But it's a pattern of higher highs, higher lows, and it should be just a matter of time, right? It should be, especially with this macroeconomic conditions. So it might take a couple more times, but I think eventually it will drop. I don't think it's gonna break short term because dollar is way oversold, right? The reason gold and silver are rallying because dollar is oversold. Obviously, if the dollar breaks 100 and continues to drop, then that's when that's your signal that silver and gold is gonna rally. But until then, it's oversold. It might bounce back that first 6 months, right? I think that if you set 2 and you think that the market is going to pull back, the only way it will happen is the dollar rallies, right? That puts a headwind on the market. So if the dollar does rally and interest rate rebound, at least short term for the next couple months, that will cause silver and gold pull back. So I would actually like, maybe take some profits on silver and gold, but have some core position that you're not worried about and you can trade around it. HYG, right? HYG is a proxy for risk taking, right? It actually looks, I mean, it's overbought, obviously, right? But it's still in bear market, right? It's way below, 2008, rally. It's way below 2013 or 2020, right? So it's significantly low. It's still trading in the bear market, but it's 2 weeks of higher highs, higher lows, and it's sitting on this key overhead resistance, right? Key overhead resistance, 2016 low, and every time we had a crisis in 2016 or 2011 or some, geopolitical risk or default of sovereign debt, this is the level we were, and now we are below that level, right? So really worse. So it looks bearish, but short term for the last 2 months, it's higher high. So it could be another month of higher high, but that is something to keep an eye on. Right now, the spread between triple B's bonds and treasuries continue to deteriorate, right? So the spread continues to deteriorate, high yield continues to go high. That's pretty bullish, right? 2 months of higher highs, higher low, it's a pretty bullish signal. That's why a lot of people are very bullish on the market going in 24. All right, guys, you are great. Awesome. Thank you very much. Happy New Year. Merry Christmas. We're off on Monday. There will be a closing bell today. So if you're not at the closing bell, then I will see you Tuesday morning. Merry Christmas. Happy New Year. Best wishes to you and your family and to successful 2024. Thank you very much.